Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Maddie Radner, Director on the Nasdaq Market Intelligence Desk, as well as Sanjiv, President of Pagaya. We're here to discuss why consumer confidence remains strong and the impact of tariffs on discretionary spending. It is great to have the both of you with us. Welcome to Trade Talks. Sanjiv, I want to talk about Pagaya and the data that you see that suggests that consumers are actually in a relatively strong position. Tell us about Pagaya. You're working with a number of lenders to get the right asset or the right access to consumers.
Yes. Well, thank you, Jill. Let me first describe to you very quickly what Pagaya does, and that'll explain why we get data in real time. But basically what Pagaya is an API, a fintech which does model-based lending, where the API of Pagaya is embedded on the origination system of about 31 lenders across the country. And these are like massive, large lenders like SoFi, US Bank, Klarna, Ally on the auto side. And we have essentially three asset classes where we get real-time information on what consumers are applying for and how the loans are being originated. The three asset classes are personal loans, auto loans, and point-of-sale loans. So what happens is we get to see real-time data across 31 lenders cross-sectionally, and we can see how loans are behaving across 31 different lenders at any point in time. But even though we are not a lender ourselves, we are an enabler of lending on behalf of the lender. We approve loans that a lender may or may not approve. Potentially one that a lender doesn't approve comes through their API directly into Pagaya, and Pagaya's AI-based models approve the loan and then automatically securitize it. What happens is we watch the loans as if we were lenders. So I look at 30-day delinquencies, 60-day delinquencies, and 90-day delinquencies. And because these loans that we look at, these asset classes, are leading indicators of consumer health, they give us a really good insight of what's going on in real time.
So if, for example, you see that there's stress with personal loans and auto loans, that could be a precursor to a more systemic issue.
That's correct. As I often say, that in the spectrum of consumer lending, you've got unsecured loans, as in personal loans, credit cards, and then you have student loans, and then gets into secured. So you get auto loans, home equity loans, and home loans. So generally, if the unsecured loans start behaving in a way that shows any concern, you know that that's a leading indicator of what could be a transmission effect in the health of the consumer through to the other aspects of the economy.
And what you're seeing now, consumers are managing debt responsibly.
Yes, much to contrary to what has been actively reported, the consumer is actually in pretty good health. We see that the delinquency rates are relatively stable. I mean, they're like up 3 basis points after 60 days. And we see that in auto loans as well as in personal loans. So both asset classes are indicating that the consumer is in pretty good shape. And it could be, my hypothesis is it could be because about 4 years or so ago, a large portion of US household debt was refinanced into very low mortgage interest rates. And the value of that is showing up. And mortgages are generally a third of a consumer's debt expense. So if a third of that debt expense is at very low interest rates, that leaves a lot of disposable income to service the loans on the other asset classes quite well, even through an economy where rates are relatively higher.
And Maddie, to Sanjiv's point, there's more noise in the headlines than the market, for example, based on its performance would show.
Yep, I think when we think about tariffs, we're still continuing to see a lot of trade tensions, really continuing economic uncertainty in this environment. I'd be curious what you see in the data. I am reading a lot that a lot of product categories are being pulled forward ahead of these looming tariffs. And so we're seeing a lot of front loading of different imports, especially in sneakers and apparel, housewares, auto parts. So it doesn't seem like the tariffs have really trickled down to consumers. So that's why we're seeing such strong data there. But I'm curious when you think we might see an impact on the consumer.
So that's a great observation, Maddie, and I will tell you from what we saw in April. Post-Liberation Day, we saw that demand for new cars went up in anticipation of the front-loading effect that you're talking about. So when demand went up for new cars in anticipation of new car prices rising, that actually led to new car prices rising, self-fulfilling. But because new car prices rose, demand also shifted to used cars because the prices there were relatively lower compared to new cars. And so used car prices went up as well because the demand went up. So it kind of happened relatively quickly. Having said that, soon after the tariff talks settled down, demand settled down, and prices came back to what I call steady state normalcy. And I think tariffs, at least one data point, has demonstrated the front-loading effect that you talked about. But again, having said that, the core consumer performance has tended to be pretty good, even though the price of the utility fluctuated a little bit during the tariff.
Well, you're seeing also, increasing insurance costs is another thing, increasing repair costs, of course, as well. But the standards for getting loans are certainly tight right now, too. So perhaps the portfolio of customers that lending is being reported on is helping to frame that picture.
Yes. And I think that's true. So you pointed out a couple of things. Number one, because prices went up and insurance costs go up and a bunch of other related costs relative to a new vehicle or a used car vehicle goes up, the loan amount demand the value of the loan amount also went up. That's one thing we noticed. But we look at something called debt to income as well as loan to valuation. And those remained relatively stable, meaning the loans that we gave relative to so the loan went up, the value went up, so the numerator went up and the denominator went up, so the loan to valuation ratios stayed pretty much the same. But because automobiles tend to be a relatively fast depreciating asset, this can turn around pretty quickly when the value of the asset deteriorates much faster because it had artificially gone up during the tariffs. So we continue to be very responsible in how we lend to the cohort of consumers where the loan to valuation ratio is on sort of the border. And that's what gives our investors who buy Pagaya's auto securities to be extremely comfortable with the way we underwrite the loans, because we are very careful and watch this, not like a traditional fintech platform would, but like a responsible lending institution would.
Yeah. Maddie, that's why I think earnings that are coming up in earnest over the next week or two, it's going to be interesting to see how consumer companies report and what their guidance is like, because this, at least it's been framed, is going to be the quarter where we're going to start to see.
Yes, I think all eyes will be on earnings, which begin next week. I can't believe it's already here. But I think really this earnings season should provide investors with important insights on how companies are adjusting to increase costs, increase tariffs. And as you mentioned, elevated tariffs have yet to really weigh on sales forecasts because of this front loading of imports. So we're really going to get a sense of how corporates are spending, expectations on what they're going to be spending on for the next 2-3 quarters moving forward. We're really keeping a close eye on small cap earnings versus large cap earnings, as the gap between the two is going to continue to lessen. So analysts have forecasted that the S&P 500 earnings per share year-over-year growth will actually decelerate to just 4% for the second quarter from 12% in quarter one. So we're still seeing earnings growth in the space, but small cap companies are expected to catch up as we hopefully continue to see a rate cut, inflation continues to come back down, so their borrowing costs continue to get it a little bit easier for them.
Yeah, it makes you wonder, as it relates to consumer discretionary spending, if they're shifting it from other areas. Housing, as an example, affordability is a concern, right? Interest rates are still perceived as to be high. I wonder if they're shifting some of their spending that would have went into moving or acquiring a new home into other areas of discretionary spend. Okay, maybe we'll get a new car, maybe we'll travel instead. So I wonder if there's some shift. I mean, there's no evidence to support that, but.
I think the hypothesis is very sound, because there isn't a whole lot of, like you said, a whole lot of home buying. there must be a lot of disposable income, which is probably going into some form of discretionary spending in other areas. I mean, I see the restaurants in New York City, for example, are full all the time, including in many of the suburban towns. And you say, well, this doesn't look like either inflationary or the beginning of what was being talked about a few months ago as a recession. Doesn't seem like that at all. And I do want to highlight one more thing. Because Pagaya deals with 31 lenders, as I mentioned, auto being a major part of what we do, but we see the behavior of the lenders across the board in real time as well. We have actually not seen a perceptible change in the credit criteria yet either. And I say this because that's another sort of a narrative that's out there, that the credit boxes are shrinking for the lenders. We haven't seen that. I will say to you that lenders have been very responsible through the tariff cycle because it was kind of new and unknown. But the credit box hasn't really shrunk, nor has it expanded in anticipation of the animal spirits that were being talked about in January. So it's kind of stayed cautious, and I think it's mainly because, and we'll see evidence of that in the earnings reports, as you mentioned, Maddie. But I think it's because at the end of the day, lenders believe that consumers are behaving relatively responsibly. There is disposable income that's available. They are paying their loans relatively on time, and that at some point in time there will be earnings pressure. And so they can't shrink and then expand again. So lenders are being cautiously optimistic, in my opinion. And I think if rates do go down, we will see some growth in, towards the.
I mean, I'm also hoping that a lot of lessons were learned following the great financial crisis. You do not want that housing bubble to, I mean, if you were able to secure lending, even if prices weren't inflated, perhaps that's what's keeping it a little bit more balanced?
Trust me, I was in the middle of that. And so I can tell you that for those of us and for lenders that went through the financial crisis, actually not so long ago, and learned the lessons of that in real time, know that in times of, regardless of where the consumer, how stable the consumer might be, you want to continue to be a responsible lender. Because ultimately you're in there for the whole cycle. And I would say that Pagaya certainly is in that place right now, even as a lender that is adjacent to the lenders. We are very, very cautious about making sure that we are lending responsibly.
I mean, the employment environment looks completely different than it did in 08 and 09 as well.
Sure.
So, I mean, and I think, until you start to see a turn in the numbers, what are we, 4.1, 4.2%? I mean, a 1/10% fluctuation either way isn't going to really change the picture. But for all intents and purposes, if you want and are able to work, it appears that there's jobs out there.
Absolutely. And, for as long as there are jobs, people will need vehicles. For as long as people need vehicles, the auto loan business that we are in continues to do very well. I'm actually equally positively surprised by the fact that even personal loan demands have been fairly stable. And these are personal unsecured loans, and they are being paid on time, which means that in general, these are need-based loans.
Does buy now, pay later have anything to do with that? Perhaps you're not having to access credit or run up credit card bills because of other types of way to pay for products, afford products, or is that not big enough of a market to me?
It is a rapidly growing market, but I would say it's more adjacent to point of sale loans and credit card loans. So it's kind of in that category. And again, we've seen relatively good behavior even in our point of sale asset loans. They have behaved quite well. Although I have to say that the expansion of point of sale loans into very, very short term loans, that tends to be a little disturbing. If I'm paying my Seamless or my Grubhub bills in 4 installments, that tells me I'm not so sure that you want to touch that end of the market.
Yeah, well, I do agree with that. We were actually talking about that last week on a similar panel. And Maddie, just to wrap up here, another thing we're going to be looking forward to is interest rates, of course, especially in small cap space. That could be a catalyst as well.
Yep, so I work mostly with small caps listed on the Nasdaq here. So they are obviously less likely to be profitable and more dependent on these floating rate loans, as we've been talking about. So small cap loans tend to be of shorter duration, exposing them to greater rate volatility. So most of these small cap companies have a larger share of debt coming due over the next 4 years. So hopefully as we do get more interest rate cuts in the near future, they can pay off the debt that's coming up for them.
Which is interesting because savings rates have come down quite a lot. Not that mortgage rates have. So it's interesting how that happens, where there's been no movement in the interest rate, but savings rates have gone down.
Yeah, you're right. You are right, absolutely, both on the lending side as well as on the savings side. Rates haven't really moved that much, and if anything, there is an anticipation that rates will come down. Across the board, including, I can't tell you how much longer the mortgage guys are going to keep waiting for rates to come down, but I think there's a lot of pressure in general for rates to come down. So if anything, particularly in the auto side, we are very optimistic that with rates coming down, consumer performance being relatively stable, that we will continue to perform very well in the auto segment and will continue to do extremely well for our investors on the other side, because that's where the real demand is. That is driving high quality assets to be absorbed by a section of the market that understands the behavior of this asset class really well.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.